We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Hi, I'm your host, Bob Powell.
My guest today is John Nersesian, CIMA, CPWA, CFP. John is head of advisor education at PIMCO. He is also a faculty member for the IWI Certified Private Wealth Advisor and Certified Investment Management Analyst education programs held at Yale University and the University of Chicago. In addition, John is the recipient of the 2021 Investments and Wealth Institute Writing Award, which honors Investments and Wealth Institute members for their excellent editorial contributions to the Investments and Wealth Monitor during the previous year. His article, A Practical Approach to Behavioral Guidance, was published in the November-December 2020 issue of the Monitor. And John joins me now to chat about his paper. So welcome to the podcast, John.
Thanks, Bob. It's great to be here.
It's great to have you. And before we get going, though, for the benefit of our listeners who may not be familiar with you and your work, do you mind giving us a brief overview?
Sure, happy to. I've been in the industry for almost 40 years, which only proves one thing: I'm getting old. I started in 1981 with Merrill Lynch, so I did spend 20 years as an advisor. I think that perspective has been somewhat helpful in the work I do today. I also spent 15 years running the Wealth Strategies Group at Nuveen out of Chicago. And for the past 3 years, I've been working with PIMCO as the head of advisor education. Some of the listeners, I suspect I may have had the chance to work with or meet through my extensive involvement with IWI, where I served on the board for 14 years and also as a faculty member for both CIMA and CPWA over the past decade.
Right. And you've also recently authored an article that appeared in the Monitor, the Investments and Wealth Monitor, that won an award. The headline was A Practical Approach to Behavioral Guidance. And we're eager to have you walk us through what you wrote and help our listeners get a better understanding of behavioral finance.
Sounds great. Let's kind of start first with why we're even talking about behavioral finance. It's kind of funny, Bob, when I started in the industry almost 40 years ago, our job was primarily focused on managing client money, right? That's what a financial advisor primarily does. We're going to help clients allocate their dollars in an effective manner to help them achieve the returns they need in order to realize their lifelong dreams and ambitions. And managing client money, of course, is still a primary function of today's financial advisor. But I think what we've all begun to learn over the past decade or so is that in addition to managing client dollars, we have another very important responsibility, and that is managing client emotions, managing their decision-making so that they achieve the returns that they're entitled to receive.
And in the world of money management, this notion of behavioral finance, there are certain biases that people have and that advisors need to know about?
Yeah, I think so. So let's kind of start with the premise of what behavioral finance is and some of those biases that probably best reflect it. It's the idea that we assume investors are rational, or at least the Econ 101 textbook I studied many years ago at Lehigh. You probably remember the Samuelson textbook and the chart that showed guns and butter. And the challenge for the econ student was to allocate their resources effectively between guns and butter. And you were seeking maximum marginal utility. The assumption is that you had access to all the information, all the expected probabilities. And the other assumption that was key in that equation was that the investor was rational. They made decisions that maximize their utility and that serve their best interests. Unfortunately, that may work in the Econ 101 book. It doesn't always work that way in the real world. Investors are subject to biases. There are two primary forms of biases. One is a cognitive bias. It's the idea that we look at information and despite our best efforts, we synthesize it and use it to draw incorrect conclusions. The second form of bias are emotional biases. It's the idea that we come to the equation with a certain emotional makeup, and these biases lead us astray. They cause us to make decisions or act in ways that don't necessarily serve our best interests. So I think that background is helpful in understanding what we within the industry are referring to in terms of behavioral bias. You want to talk about a couple of the key ones that we see?
I think so. That would be appropriate.
Yeah, well, let's jump into a couple of them. Let me start with loss aversion. So nobody likes to lose, right? We're all competitive and we all like to see positive results, et cetera. Loss aversion is predicated on the idea that losses hurt worse emotionally than a corresponding gain feels good. I think Kahneman and Tversky did a lot of work on this, and the asymmetry between the emotional joy that we derived from a gain and the emotional duress that we endured when we actually lost money. And because of that, because there is this 2-to-1 ratio between losing capital and winning capital, it causes investors, unfortunately, to do things that don't necessarily act in their best interest. It forces us, for example, to keep more money in cash or safe types of investments because we don't want to endure the emotional pain of a poor choice. Obviously, keeping all our money in cash or secure instruments comes at a cost, a return cost. The second example of loss aversion is the investor who buys a security. I don't know, maybe they bought GE, for example, back when Jack Welch was running the place. They bought the stock at 60, the stock declines to 50, and the fundamentals have changed. And maybe now there's a valid research reason as to why the investor should exit the position. And the client responds by saying, I'm not going to sell my GE stock at 50. I bought it for 60. I'm going to wait until the stock gets back to my original purchase price, hoping or assuming that it eventually will. It's the idea that investors don't want to admit a bad decision and don't want to actually materialize, if you will, a financial loss. So loss aversion is really powerful.
There are several others. Recency is on your list?
Yeah, I'm glad you mentioned recency. And by the way, there are probably 20 different biases. We created a little behavioral finance guide that defines and identifies some of these biases and maybe provides some illustrations as to how they're generally portrayed by the investor in their decision-making process. But recency, one of the most powerful. It's the idea that as investors, we don't consider all of the information before us in drawing conclusions and making decisions regarding future returns. We make today's decision based on what just happened yesterday. The more recent results have a stronger influence on the choices we make today. And so, for example, in the paper, we show a chart of the return of the S&P 500 from 06 to 2010. And as our listeners may recall, 06, 07 were really strong years. Markets produced some really great results. Investors, of course, enjoyed those experiences. They derived a lot of emotional satisfaction from making money. And of course, they added more capital to risk assets during that rising environment. Eventually, of course, the market cycle changes, market heads down. Investors don't enjoy that nearly as much. They become duressed, and they wind up using the decline, Bob, as an excuse to liquidate their investment holdings. Recency bias is maybe one of the greatest contributors to that disconnect between investment result and investor result. And I know that our viewers have probably read or seen a lot of the research that's been done on that subject as to how the average investor has a tendency to underperform the investment markets in which they participate.
So when I think about the other biases and the need for advisors to understand them, there are several others: framing, anchoring, overconfidence. Any of those that are worth mentioning and sort of jump to the top of the list?
Yeah, let me identify one of them that's really become very prevalent today, and that is the idea of overconfidence. And I'm really referring to now the bias that affects the investor. I'll come back and talk a little bit about framing because I think that has a really a positive impact on the advisor relationship. Overconfidence is the idea that we sometimes assume we can control certain outcomes where we can't. It's not to suggest that we're not capable. It's not to suggest that we're not intelligent. It's not to suggest that we're not well educated. It's the idea that many investors allocate time and effort in areas or functions that don't necessarily provide a strong or positive return. We try to time the market. We think we have the ability to do so. We look at the headlines of the day and we trade our portfolios more frequently. And so many studies have been done that prove rising confidence, active trading, the increased frequency of portfolio turnover generally leads to lesser results, not greater results. So we encourage investors to really think about that and to instead reallocate their efforts and energies to the things that have greater influence on their outcomes. Instead of trying to time the market, maybe I should spend more time developing a solid financial plan. Maybe I should focus on things I can control, like my risk budget through diversification, like lowering my investment costs, like minimizing my taxes. So overconfidence is this idea that we have a tendency to overestimate our abilities, and that overestimation leads us to allocate time and effort in areas that are maybe not productive. Let's talk a little bit about framing, since you brought it up. Dan Ariely, Duke School of Business, or Fuqua School of Business down at Duke University, he really tackles this subject quite well in his book and in his lectures. Framing is the idea that investors respond to information that's presented, not just based on the fundamental facts, but the context in which they are presented. And so let me give you an example. I'll use a non-financial example. Bob, I go to a doctor because I've got a certain pain, and the doctor diagnoses me. And he comes back and he says, John, this is what I've diagnosed for you. But the good news is I'm going to recommend a certain procedure. In fact, the procedure that I'm recommending, all patients who undergo it, 5 years later, there's a 90% chance of success. You'll still be alive 5 years from today with a 90% probability. Okay, that sounds like a pretty fair recommendation. I go to see a second doctor, and sure enough, this second doctor diagnoses me with the very same illness, and he in fact recommends the very same procedure, but he does so in a different context. John, this is the disease that you have. This is the procedure that I'm recommending. If you undergo what I'm recommending, 5 years from today, there's a 10% chance that you'll be dead. And so, of course, we can see or tell that the odds are identical in either case, but our response to the recommendation is greatly influenced by the way in which the recommendation is framed. I really think that as financial advisors, we can do a better job of understanding our clients' emotional makeup, the communication forms that they respond best to. There's an old adage, I'm sure I'll screw it up. There's an old adage that says that we often present information, but decisions are often made not by the information that's presented, but the context of the story that's used in sharing it. And so I encourage all of our listeners today to kind of think about, I'm sure the advice that we're delivering is great. Are we spending as much time, energy, and thought as to how we're sharing our recommendations for maximum impact?
So in the article, John, we've talked about some of the impact of these biases already, but you mentioned two studies, one of which I was actually involved with years ago when I worked at Dalbar, which was the qualitative analysis of investor behavior, which was a landmark study in many regards, because it did demonstrate this notion of ultimately investors buying at the top and selling at the bottom.
Yeah, maybe I should be interviewing you for this segment, Bob. I had no idea that you were involved in the original study, but it doesn't surprise me in the least. And we've seen a number of research reports and studies that draw the same conclusion. And I really do apologize in advance if sharing this information appears as if I'm being critical, because that's not the goal. It is not to deride the individual investor or their capabilities in any way. It is to suggest that successful investing is often a counterintuitive process, and that unfortunately, many of the biases that we've discussed so far have a negative influence on the decisions we make and the returns that we receive. And so in the article, I refer to this study that was done by Dalbar, and they look at 20 years of returns, and they look at the S&P 500 as an equity proxy, and the return on that index was just over 6%. We look at the average equity fund investor, who over that same period of time earned a return of 4.25%. You know why, right? It's because when markets are strong, we allocate more capital to the markets. When markets are weak, we have a tendency to remove it. What I'm really contrasting, or I think what the study is contrasting for those folks who study investment consulting, it's the time-weighted rate of return, the return of the investment, as compared to the dollar-weighted rate of return, the investor. And the difference between the two, of course, involves cash flows. When do you get in? When do you get out? When do you add money? When do you withdraw money? And as I mentioned before, the reason that the investor results often trail is because emotionally, it's very difficult to make these decisions at the right time. Successful investing is counterintuitive. Now, a lot of our friends on the line may say, John, what's the big deal? What's 175 basis points between friends? Well, you know me, I'm a CFP, and I pull out my HB12C and let's play a game. Let's go ahead and put $19,500 a year into a portfolio, and let's do it for 40 years. That is, of course, the maximum 401k contribution in 2021. And the results are stark. That minor difference in return produces a meaningful difference in terms of terminal value. The return based on the market itself was just over $3 million. The return for the investor result, given that behavioral deficiency, is less than $2 million. There's $1 million difference in terminal outcomes. Maybe that's the cost of our bad behaviors. And in fact, Carl Richards, you might know Carl, Bob.
I do.
Yeah. He's very involved in the planning world, and he wrote a really good book called The Behavior Gap. He does a good job of illustrating these differences between market returns and investor returns as well.
Yeah. So it's been a while since I looked at the Dalbar study, but one of the interesting parts about it back then was the notion of one, buy and hold, but also the importance of the advisor and in the advisor's role in maybe stopping the investor client from doing things that they would not be in their best interests. So that in a way brings me, I think, to the other section in your paper, John, which is about best practices for advisors, given all that they now know about behavioral finance and the biases that people have.
Yeah, I'm so glad that you bring that up. And we can certainly dive into some of the best practices and talk about how an advisor can communicate their value, their very important contribution to investor outcomes. And I know that so many successful teams have different ways in which they describe their capabilities. I help you make the important decisions to achieve your financial objectives, try to take some of the complexity out of successful investment decision-making, et cetera. But maybe the greatest way to articulate an advisor's value is that through my guidance, through the discipline that I try to instill throughout a relationship, I hope that we make better decisions and I allow you to achieve the returns that you're entitled to versus the returns that you would likely achieve on your own. I'm a big believer, Bob, that at the end of the day, the greatest cost to today's investor, it's not the 50 basis points a year that the advisor charges them as a nominal planning fee. The greatest cost to today's investor is the cost of the bad decisions they would make without that professional guidance or help.
Right. And I often say that they'll never know that until it's too late.
Yeah, we learn these lessons, unfortunately, after the sins have been committed, right? It's like, oh my gosh, now I realize how smart you are. Now I realize why I needed your guidance and your help. It's hard to anticipate mistakes we would make or value we would derive in advance. It appears to be a rather straightforward or easy process. It's only until we make those mistakes when we realize, oh my gosh, I really would have benefited had I had maybe a more disciplined plan or approach and benefited from that outside perspective. So let's talk a little bit about some of these best practices. We've identified a number of them in the paper. And I will admit to you, Bob, that some of them are probably obvious to our listeners. Some of them may be new and may be insightful. And I hope there's some value in sharing them. The first of which is to really take a long-term perspective. And we get that, right? That as investors, our odds of success go up when we maintain a long-term perspective. I know that stocks on average over 10% a year. I know that bonds average over 5%. I know that my return on cash is going to be somewhere between 2 to 3. Volatility, of course, is the price I pay for the opportunity to earn higher returns. We have to encourage our clients to think about maintaining a long-term perspective. I know that for retirees, for example, we've got a target date, age 60 or age 65, and we invest with that target in mind, assuming that that is the end of our accumulation experience. Well, you know this as well, if not better than I do. 65 is just the beginning of chapter 2. It's not the end of any particular story. I've got another 20 or 30 years to go. And so the question is how do I allocate capital and make financial decisions that keep that time perspective in mind, where I can use time to be my friend or my ally? If I look at equities as an example, Bob, and you ask me what are the odds of having a positive return a year from now, the odds are slightly in my favor. There's a 55% chance I've got a gain. There's a 45% chance historically that I've suffered a loss. If I go out 5 years, the odds increase. They go to 85-15. If I go out 10 years, it's 90-10. If I go out 15 years, it's 100-0. And so the question I ask us rhetorically is, what's your time horizon? I mean, I know that we measure returns annually. That's just what the industry does. We measure them annually. But am I investing capital today with a goal of liquidating all my dollars in exactly 1 year? Let's encourage clients to maintain a longer term perspective, and they can use the benefits and the higher returns of risk assets to their advantage.
In the article, John, you talk about appealing to a client's emotional approach and then adopting a client perspective, which again, it may sound like advisors do that naturally, but maybe they also have to learn that too if they haven't been doing that.
Yeah, I think so. And once again, it's nobody's fault. It's not to be critical. When I started in the industry, Bob, I wasn't trained on any of this. The training that we all endured was investment related, how to do security analysis and discounted cash flows and how to construct portfolios and correlations of asset classes. Not to say that those functions aren't important, but that was the bulk of our training and our focus. To be a great financial advisor, you had to learn those competencies. Or maybe if you were a planner, you learned about retirement planning and tax planning and things of the like. One of the things that I think we would all benefit from is learning or adopting an emotional approach to dealing with clients. How we understand, and I hate to use the terminology, how we profile or identify a client's emotional makeup. So all the great advice that we deliver is done so in the appropriate context and has a greater chance of resonating.
What, in the paper you talk about, we've discussed the impact, the identifying investor behavioral risk, and talk a little bit about that.
Yeah, I'm so glad that you mentioned this idea. It's another best practice to try to improve investor outcomes and deliver the kind of advice and guidance that our clients want. Returns are easy to measure. When I say easy, I mean that there's a mathematical answer to that equation. What was my return? Well, I'm going to start with my opening balance. I'm going to account for cash flows. I'm going to calculate the ending balance. And I can calculate for you, Bob, your arithmetic or geometric rate of return. There is a numerically accurate answer when it comes to returns. Bob, I've got a question for you. How do you define risk? How do you measure it? And I'm not trying to be facetious. Risk is an ambiguous topic for many investors. Yeah. Risk may mean to certain investors volatility. We as financial professionals, we use standard deviation, the variability of returns around the central tendency. It's a measure of volatility or consistency. And I get it. As an institutional investor, that probably makes sense. I'm trying to minimize that volatility to provide me with emotional comfort, but that may not necessarily resonate with the retail investor. We use other tools like beta. Maybe beta is the proper way to measure my risk. What is the expected volatility or response of my asset classes given a directional move in the market? But maybe the best way to think about risk is the way that it affects our clients emotionally, in addition to financially. And so we assembled a number of questions that we think can be helpful in that regard. So the question that I would ask is, and this I think is a great way for the advisor to demonstrate professionalism and thoroughness to their clients, in addition to capturing the information they need. So, Mr. Client, how do you think about risk? What does risk mean to you personally? How do you measure it? And maybe most importantly, how have you managed it historically? And then we can get into some questions that I think really evoke responses that allow us to better understand a client's tolerance to risk. What would be more upsetting? Selling a security and watching it to continue to go up, or holding it and watching it decline? Would you prefer a portfolio that exhibited greater variability but higher returns, or one that was more stable, accompanied by a lower rate of return? This questioning methodology, I think, is important for us to really gain the insights required regarding our client's personal definition of risk. Now, I want to offer a caveat. We have these conversations with clients, hopefully in advance of market occurrences, right? That's the best time to apply them. But even then, they're not perfect, because clients often respond to these questions and share this information in the comfort of your conference room before the volatility has actually occurred. Yeah. Once they endure it, their psyche and their response often changes. And so maybe these are used at the front end of the relationship to try to give us the guidance we need to properly guide or counsel our clients. But maybe an effective time to use them again is during periods like March of 2020. Right after that decline, let's talk to the client. I'm convinced that if I'm working with 100 clients, 50 clients are going to say, boy, this didn't bother me at all, John. You prepared me for this. The historical information that you shared with me prepared me for this kind of experience. And I'm pretty confident that we've got a great long-term plan in place. Other clients are going to respond by saying, oh my gosh, I had no idea this could happen, and that didn't feel very good at all. Let's go back to the drawing board and rework the plan to make sure that I've built a portfolio that I can live with personally. So,
yeah, it's one thing to say how you feel about risk during a bull market, and a whole nother during a bear market, I suppose.
Yeah, I love volatility when it's upside volatility. It's the downside stuff that causes me to lose sleep at night. And by the way, that is a great commentary about one of the common risk metrics we use. Not to suggest that it's completely ineffective, but one of its deficiencies. We use standard deviation, right? You and I talked about this in a piece that you were doing on Monte Carlo and retirement planning. Standard deviation is the common metric that we use. And as you know, standard deviation measures the variability of returns in both directions. It's called two-sided risk. It measures the variability to the upside and the variability to the downside. But unfortunately, if we're really applying this to a client scenario, clients don't mind the upside volatility. That doesn't bring them duress. It's the downside variability that is, of course, most concerning.
Yeah. I'm going to make sure that folks go back, if they haven't, to read your article, because that list of questions is worth every minute spent reading them and then implementing them, no doubt. Which brings me to this notion, you've sort of hinted at it already, this notion and the importance of maintaining perspective.
Yeah, perspective is important. And that's one of the reasons that at the beginning of the planning process, we talk to clients about time horizon, right? I mean, so the very, very, very fundamental inputs when doing planning or investment allocation is, what kind of return do you need to achieve your financial goals? How much risk or variability are you willing to assume? And what's your time horizon? So I know that we ask the question because we've been trained to do so, but do we really align portfolio recommendations in the context of an investor's time horizon? Time becomes our friend. It's a great asset. It allows us to ride through the inevitable variabilities of market returns. Once again, this idea of variability or inconsistency, it hurts and it's painful when we endure it. But that variability, that risk that we endure, is the price we pay for the opportunity to earn the higher returns that we seek.
So this notion too of portfolio diversification as a way to reduce volatility then becomes important in some ways.
Yeah, I'm sure that everybody on the line with us today, they understand diversification, right? It's the idea of allocating assets or securities to, across different asset classes or exposures. But the question that I often ask is, why are we doing it? And I'm not sure that the investor actually understands the real purpose behind diversification. In fact, what I've often heard is, all right, I build a diversified portfolio for my client. We own stocks and bonds, and we have large and small, and we have domestic and international. We may own real estate and commodities and other asset classes. And at the end of the year, the only thing that the client is focused on is the one exposure that didn't do well. He had hoped or assumed that everything was going to go up. And I think they're kind of missing the point. Diversification is an effective tool to moderating volatility. It's the one free lunch in investing. And you know it, and I know it. Every time I diversify, I get 100% of the weighted returns of the asset classes that I'm exposed to. But in doing so, I am exposed to or assume something less than 100% of those weighted risks. That is efficiency. If you want to calculate it, pull out your calculators and run a Sharpe ratio, right? The Sharpe ratio is the return of my portfolio minus the risk-free divided by the standard deviation. It's a measure of efficiency, and it's driven by two inputs, not just my return, but the amount of risk or volatility I assume in earning that return. And diversification is what allows me to build more efficient portfolios. Diversification and minimizing volatility, it helps me in two ways, Bob. One way is obvious. It's emotional, right? It's those downdrafts like March that cause me to sometimes abandon strategy. And that obviously leads to substandard results. But I know you know this as well as anybody. Volatility really hurts me during the decumulation phase. Because by definition, once I'm retired, what am I doing? I'm spending down corpus. And so if my portfolio exhibits a lot of volatility, in a given year when the market's down, I am forced to liquidate more assets at a depressed price. And we can talk all day long about how the market eventually will come back, but that individual investor may never recover because they have less money in the market due to the fact that they were forced to liquidate during periods of market decline.
Right.
So managing volatility and using diversification to do so is really important.
Yeah. So obviously, if you've created a properly diversified portfolio, at some point you'll need to rebalance it.
Yeah, let's talk about rebalancing. Rebalancing is a fantastic tool for a couple of reasons. I wrote a paper a number of years ago for IWI on portfolio rebalancing, and I back tested, I think it was 20 different methodologies, Bob, annually, monthly, quarterly, 5% tolerance, 10% tolerance, et cetera. Rebalancing back to target, rebalancing back to the top of the range. I tortured it as best as I could to get the thing to scream, and it did scream, but what it screamed was a little surprising to me when I looked at the numbers. At the end of the day, how you rebalance was less important than simply the decision to rebalance. So I'm less concerned or focused on whether you do it quarterly or semi-annually. What I'm more concerned about is that you use the disciplined process of rebalancing to bring your portfolio exposures back into alignment. Rebalancing forces the investor to do what is emotionally uncomfortable, but financially productive. And again,
so there's a topic that you write about in the article that's perhaps one of my most favorite topics.
Yeah.
And maybe it's the one that precedes how you allocate your assets and when you'll rebalance, and it's the investment policy statement.
Policy is so important, and that is very much connected to this idea of rebalancing, right? When I rebalance, Bob, by definition, quarterly, monthly, semi-annually, whatever your methodology is, what are you doing? You're removing the overexposures in your portfolio, and you are reallocating the dollars to the underweighted asset classes or sectors as defined by your policy statement. So at the end of the day, everything that we're doing is really governed by the quality of and the effort in constructing a policy statement. And I know it's a big factor as part of the CIMA certification program. I know that a lot of institutional consultants, they won't even take on an engagement unless they've had the opportunity to work with the client in developing a policy statement. I'm finding that more and more wealthy families are interested in and working with their advisors to develop a formal investment policy statement. And I do want to talk about the benefits of a policy statement. Some might assume that the benefit of the policy statement is this beautiful 10-page document that we wind up with at the end of the process. The paper's nice, but at the end of the day, it's not the document that really drives the benefit. It's the process of creating it that really drives the benefit. It's the conversation that the advisor and the client have before they begin this journey. What is it specifically we're trying to accomplish? What are the constraints that I need to be aware of? What is the level of risk that you're willing to assume? What are your liquidity requirements or cash flow needs? How are we going to invest this capital together? Are we going to use a strategic approach or a tactical approach? Are we going to expose ourselves to all asset classes or focus on certain ones that maybe fit your profile a little bit more accurately? How often will we rebalance? How will we think about reviewing our performance and potentially making changes to the strategy? All of these discussion points are so much better identified in advance of the relationship as opposed to dealing with them on the fly. And so I found that great advisors are using policy, number one, to create this essential roadmap for them and for their clients, but number two, to demonstrate their professionalism and the thoroughness of their approach.
Yeah, it strikes me too, John, that in maybe not explicitly, but implicitly, it's also dealing with some of the behavioral biases, perhaps loss aversion or recency or overconfidence, all within this one document. You can address many of these biases that your clients might have.
Yeah, I love that. So we think about the process of creating a policy statement. Maybe we do it to cover our butts. It's a required methodology that we're getting the client to sign off on what we're doing, in advance of actually allocating their capital. But I'm with you 100%. If I've got guardrails in place, if I've got a defined methodology that governs what we're going to do, how we're going to do it, and when we're going to do it, I'm less likely to let the emotionalism of the day, loss aversion, recency bias, overconfidence, and many others that we've discussed in our article, I'm less likely to let those behavioral biases cause me to commit some sort of knee-jerk reaction. I go back to this founding document and I use it to really reflect on what it is I'm trying to accomplish, the approach that we agreed upon, and I use that for implementation, particularly during periods of market volatility.
Yeah. I would be remiss without mentioning one other topic in the paper that you wrote about automated investment programs.
Yeah. Let me think how I can describe this in the most positive of terms. Here's an attempt. Tell me if I'm successful, by the way. Sometimes we're better off taking the client out of the equation. Now, I don't mean that critically. I don't mean to suggest that our clients aren't capable. They are. They're very successful in their chosen fields. They're great people. This is their capital. We have an enormous responsibility, not just to manage their money, but to help them achieve the things in their lives that are most important to them. But if we can develop methodologies that eliminate the need to constantly make continuous decisions, if we can put certain functions on autopilot, by definition, there's less chance for us to commit some of these mistakes that are driven by emotional bias. And so in the paper, I refer to two different methodologies that use some form of automated investing. The first of which is dollar cost averaging. And you know this, given your planning background, our friends do as well. Dollar cost averaging, it sounds so darn fundamental, but it's a perfect example of how we can use an automated approach to investing to our advantage. It's the idea that I invest a constant or fixed dollar amount at regular intervals. And by definition, if I'm doing that, if I'm following that in a disciplined manner, I'm buying fewer shares at higher prices. I'm buying more shares at lower prices. So what I eventually wind up with is an average purchase price that's less than the average market price during the accumulation period. So dollar cost averaging can be, I mean, if you ask me to buy when prices are low, it doesn't feel good, Bob. And I know it's probably the right thing to do financially, but it's a difficult activity emotionally. And so once again, dollar cost averaging or automated investment programs like that can really help the client engage in activities that are productive on a longer term basis. The second example of an automated investment program that may help to eliminate some of these behavioral biases is the growing use of model investing, right? So in models imply that there's some sort of an overlay function that's being performed either by the financial advisor, by the brokerage firm that they work at, by the asset management firm like my organization, et cetera. And they're providing that overlay. They're making the tactical decisions as to which asset classes are going to be exposed, when to overweight or underweight certain sectors, and then which securities or funds to use in constructing the model. Now, don't get me wrong, there's still plenty of important work to do. The advisor has to, once again, really understand the client, what they're trying to accomplish, understand their risk profile and their behavioral biases and their emotional tolerances as well. These are important functions that the advisor needs to play. But the idea of using a model helps to eliminate some of the day-to-day decision-making that the client often has to engage in that can lead them astray.
Right. So we've covered a lot of ground. Is there anything that you haven't touched upon that you like to mention, or anything that you've already mentioned that you might want to reemphasize?
Yeah, I guess a couple of things that I would talk about. One other tactical approach that may provide benefit, particularly during this period of market volatility, is a tactic that I refer to in the paper, Bob, known as asset bucketing. Now, this is not asset allocation, it's asset bucketing. Let me define what it is. Michael Lurch, who's been a great IWI contributor, he was at Merrill Lynch. He was, in fact, I think the head of behavioral guidance before he took his new role over at Wells Fargo. He did some really good work on this concept of asset bucketing. Let me explain what I think is meant by it. So normally as financial advisors, we try to look at a client's total assets. And I certainly understand the benefit of doing so. If I know exactly what the investor owns, what their exposures are, I can coordinate my advice in a comprehensive manner, being aware of all of the different exposures, both in terms of asset allocation, security selection, tax minimization, et cetera. But when I look at all my assets in aggregate, Bob, when I look at everything as a single lump sum value, unfortunately, during periods of market decline, it causes me duress. So let's go back to March of 2020. Market's down 30%. Maybe my portfolio's down a similar amount. And I've got a tuition check that's due the next month. That decline is really affecting me financially and psychologically. And so maybe using this form of mental accounting, maybe what I do is I identify different financial goals in the client profile. Short-term goals like paying a tuition check, an intermediate goal like buying a second home, a longer-term goal like funding a 20 or 30-year retirement horizon. And what I do intentionally is I build portfolio sleeves of the required amounts to immunize or meet these objectives, and I invest that capital with the risk tolerance, with the time horizon, with the appropriate asset class exposures that provide the client with comfort that they know that their short-term obligations have been satisfied. And in doing so, it not only helps on the short end of the curve, but it also allows me or provides me with the mental confidence to invest other dollars with a longer-term horizon. So it lets me sleep at night knowing that the tuition money is available, but it also allows me to invest my longer-term capital more productively in risk assets, knowing that the front end of my liability curve has been immunized.
Right. It reminds me of in the world of retirement income, you would do bucketing, right, for short-term, intermediate, and long-term horizons, but this is on the accumulation side, let's say.
Absolutely. Yeah. You can do it on the accumulation side. You can do it on the distribution side. I know that, Bob, I know you have tremendous depth of expertise in retirement. one of the big challenges that so many people face today is, all right, I've done a good job accumulating. How do I distribute, right? How do I think about taking this corpus of X number of dollars and distributing it in a sensible fashion? The challenge that so many retirees face is that they have two very fundamental objectives, and they're both important, but they're in direct conflict with each other. My two goals as a retiree are, number one, to make sure that I don't outlive my capital, right? That's first and foremost. The money's got to last as long as I do. But the second objective that I have, which is probably equally important, is maximizing my lifestyle while I am around or in retirement.
Yeah.
And as you can probably tell, those two goals are equally important, but diametrically opposed.
It's a challenge. I don't want to leave without also mentioning that your paper is one of many opportunities that advisors, members of the IWI, have to become more knowledgeable about behavioral finance. There's an online program, for instance. There have been in-person programs in the past. It's a topic that the IWI feels very strongly about, not just Sharpe ratios and standard deviation.
And I love the way that you put it, Bob. So thanks for doing that. It's not instead of, it's in addition to.
Yeah.
Well, we would never suggest that an advisor's sole function is to be a behavioral psychologist. There is a competency that is required to understand capital markets and investing to help clients make the important financial decisions before them. But it also involves, in addition to IQ, it involves an EQ, an emotional quality as well, to make sure that we can take this great competency, these great skills, the great guidance that we're able to deliver, and we can do so within the context of understanding our client's emotional makeup.
Yeah.
The advisor who has the ability to go beyond just the financial facts and figures of the client. How old are you? When do you want to retire? What's your annual income? What's your marginal bracket? The advisor who has the ability to really understand their client's behavioral makeup can deliver advice that leads to a more satisfying experience to the client and a greater probability that they'll stay the course and achieve the results that they seek.
Well, I can't think of a better way to end our podcast and our time together, John, than with those comments. So I want to thank you for being a guest on the Exceptional Advisor podcast.
It's my pleasure, Bob. I really enjoyed the chat. Thank you so much for including me.
Thank you for listening to the Exceptional Advisor podcast, brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.